It's really focusing on the idea that you're not trying to make money, you guys, when we're investing. The objective is to not lose any. And that means not that the stock price never goes down from where you bought it. We have that happen on a regular basis. The point is that the value of the business doesn't go down from where you bought it, and preferably stays well up above where you bought it because you bought it with a margin of safety. So not losing money means over a 5 to 10 year period, you don't have a permanent loss of capital. So the key to that is you do what Allan said. You get a safe business at a good price and make sure you understand the whole thing. So he says that they have really one goal in mind when they're structuring their policies and philosophy of this, and that is to encourage rational decision making. And that's what leads to really good returns, rational decision making. So the research process that this good investor goes through is about trying to be very rational and very objective and not get into confirmation bias, not get into trying to be defensive about something where you start to think this is a good thing and then feel like you have to follow through on that, and being very careful about staying well within your circle of competence. A rational decision-making process means that you are aware, you're very objective about what you know and what you don't know. So I think that's really good to follow. So he says the first thing we do when we're going to try to be very rational about things is we adopt a mentality of a business owner who's buying for keeps. So Lee Lu says the same thing. We don't want to look at things per share necessarily just because it gives us a bad habit of thinking that we're buying shares of a company. What we want to think about is that we're buying the company. So we think about it one way is to think, well, my uncle just gave me this company. What am I going to do with it? Well, the first thing I'm going to do with it is try to understand it so I know if I've got something that's worth keeping or if I should just get rid of it as quickly as possible because it's not a good business. So we think about that for every company we buy. Do I want to own the whole thing? Would this be a good company for me to own if it was the only company I owned? So he says, if we're going to buy for keeps, what that means is we're thinking about the staying power of the business. How durable is the business? We're thinking about competitive threats. Again, do we have a moat here that protects us against competitive threats, or are they tearing down the moat? And in more and more modern business, we see that the moat is very difficult to keep for a longer period of time. Businesses are being sold out. They're going out of business faster today than they did 50 years ago. Information is transferred more quickly than it was 50 years ago. And when somebody is knocking out a really high rate of return, real high return on assets, real high return on equity, then other companies that are in that world are going to think, hey, we should move over into that business. You know, some conglomerate with billions of dollars doesn't know what to do with would look at over and go, hey, that trucking business looks pretty lucrative. Let's go enter that business. So, you know, what are the competitors doing? Are they threatening us in some way? What are the economics of the business? Does it require economics of the business means, does it require a constant input of capital to replace all the machines and equipment that we're using to do this business? Are we constantly having to compete on price in some way, or do we have big margins, big profit margins? Can we grow the business without incurring debt? Can we grow it out of free cash flow? Those are the economics of the business. And then finally, comparing price to value. So you guys know from listening to the podcast for a long time that we're all about figuring out the value and then working out the price, or we're all about just finding a price that's really good, even if we don't know what the value is, other than to know that with a high degree of certainty, this company will be more productive in 10 years than it is today, and we're buying it super cheap. So we don't really have to nail down the value of the business per se, so much as to nail down a real big margin of safety price of a business that is worth substantially more than we're paying for it and will be worth much more than that down the road. So that's the idea of getting a good price, getting a margin of safety. So he compares his fund to what's normally out there, talking about what goes on CNBC, or financial television, keeping score of quarterly beats where that company had earnings expectations out there by the analysts, and then it outperformed that, right? That it beat the estimates. He says we just ignore all that. We ignore financial models. We're oblivious to the consensus estimates. We don't think quarterly beats are germane to intrinsic value. We're just betting on a company's fundamentals going forward into the future, not on investor psychology. In other words, Allan is basically saying we're not counting on investors paying more for this company out of momentum, out of beats, out of good news. We're not counting on any of that. We're just counting on company fundamentals, buying at a big margin of safety, and having those company fundamentals so obviously make the company worth more that the price will go up. He says, first and foremost, we adopt a mentality. Oh, yeah, we did that one. All right, sorry. He says, we strive to be conservative and realistic in assessing our opportunities. We pay a close attention to our own limitations. He said, while the revered margin of safety concept is frequently cited and often beneficial, in my opinion, it's prone to misuse. An old saying comes to mind. It's not the bad, where are you at here? Oh, shoot. Hang on. There's page 6. There we go. It's not the bad ideas that cause problems. It's the good ideas taken too far that cause problems. So he says, basically, you got to be really intellectually honest. And that means in my view, that means be intellectually humble. When you start digging into a company, you have to just remember, you weren't the, I'm talking about myself here particularly. I wasn't the smartest guy in the school, right? Not the smartest guy on Wall Street. There's going to be a lot smarter guys who figure out stuff a lot better than I do. What I've got to be able to do is make sure that I'm smart enough to figure out this, whatever this is. If this happens to be, let's say a real estate investment trust, a REIT company, I got to be smart enough to figure that out. I've got to be able to, if I've got issues that I don't understand, I've got to get a hold of people who do, and they can explain it to me until I do understand it. If I'm not sure about management, I've got to get sure about management. I remember Lee Lu telling a story about figuring out Timberline's management. He got on a plane and flew to the CEO's hometown and went to his church and asked people as they were walking out of church on Sunday what the integrity level was of this guy. And then he went to his country club and asked the same questions. I mean, that's intense, right? That's like wild man stuff. So I love that. And that's all about being really careful. He said that the value of a company is derived from what it produces for its owners over its lifetime. This is many years, often decades, right? And this supports a mindset of an investor that is calibrated toward longevity, not to what's going to happen the next quarter or even the next year, but longevity, 5 years, 10 years. And that means, from Allan's point of view, it forces us to hone in on variables that are related to durability. In other words, there's a lot of stuff that goes into whether the stock goes up or down in the next quarter. Okay, what's going on with the Fed? What's going on with the market? What's going on with the economy? Right? But what about what's going on for this company in the next 10 years? What would you look at there? What are the variables that are going on that we would need to be aware of about a company we're looking at to own for the next 10 years? If you're going to buy this company and run it, if you're going to buy a franchise at McDonald's, if you're going to buy a small business down here in your hometown, what do you need to know in order to own that business, in order to be willing to own that business and pay the price for that business? Well, the first thing you need to know is what's going to prevent somebody from coming in here and competing with me out of the blue. If I own a laundromat, what would stop somebody from just coming in and building a laundromat, a cooler one, a newer one, in a better location? What would stop them from doing that? And if the answer is not much, then that might not be our, do I want to own one business the rest of my life kind of a business? So we want barriers to entry. These are the moats, you guys. We want a barrier to entry. What would that barrier be? You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.